Thank you so much for the kind introduction. So, let me start with a question. Who of you is looking at the weather forecast once in a while? So quite a few of you, right? Who uses Netflix? Almost the same. And who uses predictions when they invest? Still almost no one, right? I know, yeah, Hodel over there. Otherwise, almost no one. So the question is why, right? Why do we trust predictions when it's about the weather, when it's about what we want to see on Netflix, but not yet when it's about investments? Because it makes a lot of sense. The complexity of the market is increasing every year, and now the data that is produced on an annual basis on the world would fill 600 billion libraries every year, right? That's 70 times more than just 10 years ago. And now, if you think that probably only 1% of that data is related to investments and financial markets, that would still fill 6 billion libraries every year. And then, how would you think that, in principle, being on top of what happens on the asset or the markets, that you can do that without any machine? So, that's the food for thought I wanted to start with. Because today we're talking about AI support in crypto asset management. We've seen the volumes, it's clear why. Now the lessons from the past, what did work and what didn't, right? We started with trying to sell short-term signals as a service, which miserably failed because it's about latencies, it's about infrastructure, it's about the fee levels that you work on. We also had clients that were doing strategy jumping, which means they wanted to have different strategies which are AI optimized, and then they looked at how they performed over the last few weeks, and then they always took the one that was doing best recently, and somehow then obviously that was not the strategy that would perform best over the next period. So no strategy jumping. Though what worked very well for us is you have to continuously retrain all the models, which we do more or less on a daily basis. And you have to do constant R&D. This is a space that moves extremely quickly. So you have to make sure you're always using and applying the latest models that are around, maybe even doing your own research around future models and how they can be used. What is also became clear for us is that the portfolio context works much better than single asset predictions. So if you work with predictive analytics and you predict one asset, you might be good at one asset, you might fail at another asset, but if you repeat that over many assets, on average, if you're better than 50% in saying whether it's going to go up or down, you're going to make a profit. So the more you kind of combine this with state-of-the-art optimization, the more you work on a large context of assets, the better the results in general. But we're going to see that there are some exceptions, especially in crypto. Let's look at some of the examples. So we have recently started to work on a portfolio which is simply using Bitcoin, Ether, and Cash as components. Cash here is in USDC, but that doesn't really play a big role. What you would see here in red is P&L of Bitcoin. Orange, we have Ethereum, and the green one is the AI-optimized version of the portfolio, which can go either 100% into Bitcoin, Ether, or Cash, or it can combine these into the portfolio. And this is only optimized actually once per week. And you would then see these periods where there were prolonged periods when the machine was fully in cash, and then the ones where you would have been invested. And you could see that in an early phase, it would almost mimic the movements of Ethereum. Then in 2022, it avoided a lot of the downside, and still then it took up the upside again on the subsequent movements. When you look at how this was allocated over time, you would see that the machine started with trying to kind of put both Bitcoin, Ethereum in, then go into cash for some period, and then suddenly it became very radical. It would usually either go 100% into Bitcoin, 100% into Ethereum, or 100% into cash. What you can see then is that in principle, and that's very interesting for everyone here in the room, right? That on most recently, already on the 15th of January, the machine would have decided to go fully into cash. So we would not have taken any of the hits on that portfolio of the last few days. And this is kind of also showing in the numbers. You would have lower volatility than a Bitcoin tracker. You would have almost double the return and consequently also less drawdown. Now this can be done over multiple portfolio types. One other portfolio that we've been running is simply Bitcoin risk on, risk off. So we can show here, we would add Bitcoin again as a benchmark. We could show here, this is over the last 3 years, a bit more. You could show that in principle, it's the same movement as Bitcoin, but it usually has a bit lower drawdown, and it's quite good at, again, picking the upside. So this is going to be something that we launch as an ETP together with the partner very soon. You can think of it as a kind of the Bitcoin ETF in smarter, because you can take risk off the table whenever the market becomes too risky or volatile. And this is fully predicted again by the machine here, even only on a monthly basis. So only once a month, the machine decides the allocation of Bitcoin and the cash part in the portfolio, and then like this you would get the drawdown down to 50 something percent instead of 70, and you would have a higher return on an annualized basis. One last example is that we worked also with a larger crypto fund which has a bit of a broader universe of around 10 top coins and tokens. And what we did for them is to compare the optimized version to an equally weighted version of their universe, right? So if you just put everything in at the same weight, you would have landed where the red curve ends here, which is still nice. It's would be around 320% plus. But with the optimized version, we would actually be at plus 864% over the same period. Same assets, just weighting them into the portfolio on a monthly basis, depending on what the engine predicts. What does it take into account? The engine looks at the prices, the histories, it constructs a lot of technical indicators, and on top of that, it looks at news plus cross-market indicators from the equity market and some macroeconomic information. So I actually had the idea to do an interactive portfolio with the audience, but yesterday everybody told me they just want to know today, what would now today the machine do? How much Bitcoin, how much Ether, or how much cash? So what we do is here, just to take that one, we look, this is the Aisot AI supported strategy. And this is already productized. We'll take this one here. Request the rebalancing. Now let's assume we had a few Bitcoins in our portfolio and some ETH. And now we want to know what would the machine do as of now, just in this moment. There's no financial advice, obviously, but you're all professional or qualified investors anyways. So here we go. So the original weight, wow, that's quite interesting. I almost hit the exact weights as it would allocate. So it would only let us sell very, very little Bitcoin and ETH. So the optimal allocation as of right now, the machine is quite bullish, going back in at 72% Ether and 27.8% Bitcoin. You also get some information where this comes from the equity momentum, equity market momentum. So usually the equity market factors are a bit at the lower level, but it makes sense, right? The crypto movements over the weekend and also today were mostly driven by the equity market and the let's say the new laws that Mr. Trump brought into action. So we heard before that the future is about AI in that space, but I think it's clear the future is now, and it's here, and there will be a new generation of smart crypto investment funds, products, portfolios, which are based on combining the human expertise with the power of AI machines like we see them here. We had our own AMC published around or live since around 1.5 years. It was more than 300% up in the first 14 months. Now it's around 270%. We reach around 30% less volatility on a Bitcoin USDC tracker at the same P&L level. And we reached more than 400 million assets under technology as of now. There's several ways of working with a tool like Aisot. You can use it as a second opinion, as an additional seat on your investment committee. You can use it in the advisory space, but you also can launch white-labeled investment products together with us. My colleague Natalia and myself, we're around here the whole day. Please find us if you're interested in what we're doing. I hope that was a bit food for thought around why we don't use more AI already in our investment operations. Thank you very much.